Hey guys, for more like this, don't forget to hit the subscribe, the like, and the notification bell. Hey everybody, it's Kevin Wadsworth, NorthStarBadCharts.com, of course, and I'm here today to talk to you about gold. I know a lot of you are interested in whether we might possibly have seen a major low just behind us, and we've moved up a little bit now, and the miners as well have moved up quite nicely. So gold and silver, also platinum, the precious metals complex, are we at a major inflection point, or do we have to look forward to further drops ahead? I've been giving this quite a lot of thought, and I've got some evidence to show you and explain what I'm thinking and why I'm thinking it. And this, by the way, is Spud. Spud the Schnoodle. He's not really very interested in what I've got to say. Sorry, Spud. It's very boring for dogs, but hopefully you'll find this a little bit more interesting than he does. So what I'm going to do is stop sharing my camera and say goodbye to Spud, and I'll start screen sharing. Let's make sure I share the right computer screen here as usual. So, okay, just quickly to start off with, on our website, if you like what I'm about to show you, we do this kind of stuff for our members all the time, looking at the evidence for different sectors, whether it's precious metals or whether it's energy, the stock market, or whether it's uranium or cannabis stocks or whatever it happens to be. We do this kind of analysis day in, day out for our members. So if you like this, then by all means, take a look at the website. And I've just highlighted the joining upgrade page there. You can get 50% discount at the moment for the month of November. We were going to do a Black Friday deal, but we thought, to hell with it, we'll have a Black November deal. So if you do join, you get 50% off, and that discount lasts for life. So whether you're paying monthly or annually, your payment that you're paying will never increase. Right, anyway, that's the boring stuff out of the way. That's probably what's sending Spud to sleep. Now the more interesting stuff, looking at gold. So this is the gold chart going back to the start of the previous bull market back in around about 99 to 2001 actually. We formed this sort of base and finished completing this base before taking off and seeing a significant major breakout. Now, some things to note on this chart, a couple of things. The first really is the support line. Now, a lot of people are drawing support lines on the non-log chart, and they're drawing support lines down to the very bottom here and concluding that this point here that we've already actually sort of broken down in some sense, depending where you draw the line, or some are saying that the support is much lower down if you draw it on the non-log chart. Now, all of those things are true and may well provide evidence. But this is also evidence, and it's corroborated evidence as well. When I say corroborated, I mean it's also supported by other stuff. And so what I tend to do, if I think we're at an inflection point, and if my sort of theory is that we're about to move in the opposite direction, in this case up, I'll start the line there. It needs to be on the log chart because price has moved exponentially from tens of dollars to hundreds of dollars to now thousands of dollars. So price is moving following an exponential trajectory. So you need to really use the log chart, unless you're doing it on smaller time frames, or unless you're looking at horizontal support, which isn't affected by log scales. Anyway, getting back to the main point, I'll start the line at what I think is the inflection point, and then fiddle around with this line to see what significance that point has. Is it important in the horizontal? Is it important in the diagonal? Can I find key support and resistance levels? And by drawing the line through this point here back in 2018 and 2019, it takes us to the point where price broke out of the arc. This arc, this sort of cup-shaped pattern down at the bottom here, which I think is significant. And in fact, if you continue the line further on, broadly speaking, it acts as a pivot line, acting as resistance there, then support, then resistance, then support. So it's actually a pivot line, resistance turned support. So it's very significant. Other supporting evidence comes from the fact that on this monthly chart, price has just hit what we call the Ichimoku cloud. That's this green and red sort of cloud-shaped drawing on the chart. And it tends to provide support and resistance. You can see here, when it entered the cloud, price bounced up and had a little bit of a hard time getting down below it. And when it was below it, it tested the underside of the cloud on multiple occasions, and then again on the way up, the cloud acts as like it's like resistance. It's like a buffer. It's like you're trying to work your way through treacle, like trying to walk through treacle, and sometimes it pushes the price all the way back down, as it did here, to touch the edge of the arc and the rising resistance line. Eventually, it broke out, back tested it, and took off. That was sort of an inverted head and shoulders there, actually, just before the takeoff. So, and in addition to all of that, of course, we've got this expanding wedge pattern that's developed. You can see the support line on the monthly chart with 1, 2, 3, 4, 5, 6 or 7 touches now. So that's a confirmed support line, which has sort of met the rising resistance line at the Ichimoku cloud. So all of those things are important. And also the 7-year rate of change I've got on the bottom, that's this black line. Why 7 years? Well, 7 years because gold has a 7 to 8.5 year cycle, and the last cycle was 7 years. So there's a significance to the 7-year rate of change. And in fact, you can see when it broke down below the 7-year rate of change here. So what I should also say is that the green line on here is its 3-year moving average. So it's the 3-year moving average of the 7-year rate of change. And when the 7-year rate of change broke down below its 3-year moving average, it coincided absolutely perfectly with this point here where the gold price began to break down. And then, of course, we went into the long bear market. Of course, when it got above its 3-year, if I just scroll back, when it got back above its 3-year moving average and began rising, that was a signal that a new bull trend was underway. So this period here that we're in now, we have been above the 3-year moving average for some time now, and so we've had this move up from whatever it was, $1,100-$1,200 up to over 2,000, and then it's consolidated in the range between sort of 1,600 and 2,000. Now, what's happened just very recently, which is significant here, and if I zoom right in, you can see, is that the 7-year rate of change came down to test its 3-year moving average, and it's bounced back up again. So that's a significant reaction that's taken place there, because had it broken down below the 3-year moving average, then the bearish case would have become more likely, but it hasn't. So the bullish case becomes more likely. And also I've placed on it this black dotted line, and it's a resistance line. You can see it was tested here, it was tested here, and it was tested here as well. So if we break out above this resistance line, which is at around about 58.5 on the 7-year rate of change, then it's telling us something. It's in fact telling us that we're likely to see a move a little bit like the move that brought us down here in the first place, being replicated on the way back up, creating an arc pattern, just like the price chart itself. I can draw that for you and illustrate it. It would be something like this. So that is what I'm visualizing. So you can see how the arc pattern in the 7-year rate of change is, if I just scroll back up to the actual price chart itself, the arc pattern in the 7-year rate of change is replicated by the arc pattern in the price action. Sorry, I'm just trying to adjust the chart so you can see what I mean a bit more clearly. There we go. Which actually led me to believe, or to try and test whether all of this price action here can be contained within a larger arc that matches the 7-year rate of change, and of course it can. There you go. So as we're testing the edge of the arc on the 7-year rate of change, we're testing the edge of the arc on the price of gold. So that is the reason why at the moment, and unless something significant changes here and we actually break below the Ichimoku cloud and the edge of the arc, so we'd have to come down below that sort of area around about $1,600 quite convincingly, and then I would change my outlook. But for now, the expectation, and this I'm giving around about an 80% probability, is a move back to at least $1,900 to test that breakout level, which if we carry that monthly resistance line down, it sort of reaches the edge of the arc right there, doesn't it? And that's going to be at around about 1930 to 1950, that kind of level. So my expectation is that between now and we'll say in the next 6 months, roughly speaking, that we will test the previous, well, not quite test the previous all-time highs, but test the breakout level at around about 1930 to 1950, that sort of level. Okay, what other evidence do we have? Well, the gold to silver ratio is very important for precious metals bull markets. And if we're going to have that kind of sustained run, we need to have seen a breakdown in the recent uptrending gold to silver ratio, because when the gold to silver ratio, excuse me, is rising, it tends to act as a tailwind, sorry, as a headwind for the precious metals market. You can see that in 2008 to 2011, we had a large drop in the gold to silver ratio, which went hand in hand with a significant uptrend in the precious metals market. And then the whole period from 2000 through to sort of 2011, the gold silver ratio overall trended sideways as both gold and silver went up. At times gold was outperforming, and at times silver was outperforming. But having the ratio break down at a critical point is a good sign for the precious metals market. When you get this very long uptrending period, that's bad for the sector. Okay, so it's not so much the small timescale ups and downs; it's the bigger picture that we're looking for here. Is it trending sort of sideways down, or is it trending sort of sideways and up? Well, more recently, we've had a significant breakdown in this ratio back in 2020, and then after an initial drop, where precious metals did well in this sort of period here, we've actually seen gold and silver struggling. But more recently, silver especially has advanced, and with silver advancing more quickly than gold, we have broken down now from this expanding rising wedge. So the gold to silver ratio has broken down. I can zoom right in to show you that. Okay, you can see this red candle here has broken down below the support line. So my expectation is for a bounce back up at some point to test the breakdown, and then for this to continue. So, you know, I'm not expecting gold and silver to go to the moon right at the moment, but what I'm expecting is a gradual change of the trend, so that over the next few weeks and months, the overall trend is up. So gold and silver should be putting in higher highs and higher lows rather than lower highs and lower lows. So that's the expectation, and I could also envisage something like this happening, actually. Some sort of a bullish descending wedge, so that we get through to, I don't know, March, April of next year, and then we see a renewed uptrend, or a breakout where gold and silver struggle again for a while, maybe for what time period is that? That's early to mid 2023 through until, that's sort of, yeah, okay, so it's sort of March, April 2023 through until maybe June. So maybe for a couple of months, or even maybe a few months, depending how quickly this goes up. So what I'm saying is, I expect an uptrend over the time scale of weeks and months. I'm expecting an uptrend for gold and silver as this continues to break down. Then quite possibly gold and silver to struggle, more particularly perhaps silver if this ratio moves up, and then for a much more significant move to the downside that would, you know, push the precious metals even higher. So maybe what this is telling us is that this is the period where gold and silver, well, gold is going to move back to that 1920 level, and then perhaps it pulls back for a little while to put in a higher low, and then gold breaks out. So that's maybe what that is telling us. Looking at the most important chart of all of this, and I've got to emphasize this is the last one I'm going to show you today, and there's much more, of course, on the website, much more supporting evidence and much more analysis. But this is the gold to SPX ratio going all the way back to the 1920s, in fact, before that into the very early 1900s. You can see when the gold to SPX ratio broke out, and then when it reached a peak and then tracked down and broke out. So in this period here in the late 1960s, we had a breakout, And we know what happened to the price of gold here. Gold went up, well, even from this point here in 1970, after the initial surge up with, you know, the breakup of the Bretton Woods Agreement and, you know, the link between the US dollar and gold, that initial reaction, I don't really like to think of that as being particularly representative, because it was a huge sort of reaction to what had just happened. But then it settled down, pulled back, and then it had another surge up. And just from there, from that point there, gold rose 700%. And then it broke down through its 7-year moving average. And there's that 7 years again. Notice how, you know, we were looking at the 7-year rate of change. Now we're looking at the 7-year moving average for the price of gold itself. And that told us when to sell gold back here, and it told us when to sell gold in the early 1980s, or when it confirmed when gold was hibernating into its bear market. And then again, when it broke out above the 7-year moving average and above the resistance line, this is the gold to SPX ratio, remember, when it broke out, that's the trigger, the confirmation that a gold bull market is underway. And after initial pullback, forming a bull flag, off it went up until 2011. And it feels to me as though we're sort of halfway there. We've got to this point here, but this point way up here, we still haven't reached. We're back there at that sort of level in the 1940s. We're at that sort of level in the sort of around 1979, 1980. We haven't returned to that level yet. We're sort of halfway through the journey. Then we've pulled back. We've actually made a higher low here compared to this low in 2000. So there's a higher low possibly in formation here. So one of two things is going to happen. Either we're going to pull back further and come all the way down here to get back as low as we were in 1999 for the gold to silver ratio. And that would, sorry, the gold to SPX ratio, and that would equate to the SPX probably breaking out and heading up and gold going nowhere. Or the alternative scenario is that this pattern here that's forming just at the moment is a little bull flag just beneath the breakout line, and we're about to move to the upside. So, you know, you may be watching this thinking, thanks, Kevin, you've just told me it could go up or it could go down. Why the hell am I? Why am I wasting my time watching this? Well, you're not wasting your time, because as soon as this crosses the line, as soon as it crosses that, the important thing is to know where this line is, where this resistance line is, because in the past is confirmed for us the bull market. So this is what's going to confirm for us the bull market, I believe, again. And when we cross this level, which is somewhere around about, currently at around about 0.485, when we cross that level, and particularly when we get to 0.5, 0.5, then we can, and we close the month above that, of course, and then close the quarter above it, because this is a quarterly chart, then we can declare the start of the precious metals bull market. And there's no need to have fear of missing out, because you can look and see just how long it takes. These are quarterly candles. It takes months and months and months, even more than a year, for, you know, the big momentum and the big moves to really start to unfold. You know, so there's no panic. We can afford to wait for the official signal. So, you know, trying to get into gold and silver stocks right at the moment, you are, you know, taking a little bit of a chance. But once this chart breaks out, then we've got the signal. Okay, I hope you found all of that helpful, useful, informative. As I say, there's a lot more evidence on the website, and individual stock charts, stock picks, trade tracker. We've got our entries and targets and stop losses and everything on the trades that we're in. We've got our verified results, along with a guarantee of how much you would potentially lose if every single trade didn't work out, which is something which is quite rare. Before you even start taking positions, you know exactly what your total risk and reward is. We use very careful risk and money management protocols so that you're fully informed when you take positions if you follow our trades. And we also have a lot of other stocks which are in our candidates list, which are in many cases just about as good as the ones that are in our actual you know, portfolio of trade tracker stocks. So there's many stocks there to keep an eye on. And we also have a heat map now, which uses sort of red and green colors to highlight sectors and stocks and ratios that are outperforming. So that's a really good go-to place on the website for a quick one view look at the markets. And of course we do chart requests and goodness knows what else. So it's all there for members. consider it if you think that you need a little bit of a hand with your trading and investing. And thanks for watching and listening, and hope to speak to you all again very soon. Bye from me, and goodbye from Spud as well. He's still asleep. Bye for now.